put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The 48-hour extinction. March 8th, 2023. Silicon Valley. A place where billion-dollar unicorns are born over breakfast meetings, where venture capitalists play God with other people's money, where the future is coded into existence by 20-somethings in hoodies. But on this particular Wednesday morning, something was wrong. Terribly wrong. In the shadows of sleek office towers and innovation hubs, a financial time bomb was counting down its final hours. Within 48 hours, the 16th largest bank in America would cease to exist. Within 72 hours, 3 major financial institutions would collapse in the second largest banking failure in United States history. And the man who would light the match, he wasn't a criminal. He was a respected venture capitalist trying to save his portfolio companies. But in the world of high finance, good intentions and catastrophic consequences often wear the same face. This is the story of how Silicon Valley's most trusted bank became its greatest nightmare, and how the very ecosystem that built fortunes on disruption found itself disrupted by the oldest force in finance: fear. To understand how Silicon Valley Bank collapsed, you first need to understand what it had become. This wasn't just another regional bank. SVB was the lifeblood of the tech industry, the invisible empire that funded the future. Nearly half of all venture-backed technology and life science companies in America banked with SVB. Half. Think about that. Your favorite apps, your streaming services, the electric vehicles revolutionizing transportation, the biotech companies engineering tomorrow's cures. Their money lived at Silicon Valley Bank. $209 billion in total assets. But here's what made SVB different, what made it dangerous. It wasn't just a bank. It was a club, an exclusive ecosystem where venture capitalists, startup founders, and banking executives moved in the same circles, sat on the same boards, invested in the same companies. The bank's CEO, Greg Becker, wasn't some stuffy traditional banker. He was one of them, a fixture at tech conferences, a member of the Federal Reserve Bank of San Francisco's board of directors, a trusted insider who understood the unique needs of high-growth startups, burning through cash like rocket fuel. SVB offered more than banking services. They offered relationships, connections, introductions. They were woven into the fabric of innovation itself. Venture capital firms didn't just recommend SVB to their portfolio companies. They required it. It was an unspoken rule of the game. You want our money? You bank with SVB. But beneath this glittering surface, beneath the innovation and disruption and world-changing ambitions, a different story was being written. A story about complacency, about concentration risk, about what happens when an entire industry puts all its eggs in one beautifully designed, venture capital-approved basket. The irony is almost poetic. Silicon Valley Bank's downfall began with success. During the pandemic years of 2020 and 2021, as the world locked down and traditional industries crumbled, the tech sector exploded. Venture capital firms raised record funds. Startups commanded absurd valuations. Money flooded into Silicon Valley like a digital gold rush. And all that money had to go somewhere. It went to SVB. Between 2019 and 2022, SVB's deposits tripled, from roughly $70 billion to over $200 billion. Banks dream of this kind of growth. But here's the dark secret that would eventually destroy them. Deposits are a liability. When customers deposit money in a bank, that bank doesn't just let it sit in a vault. They invest it. They have to. That's how banks make money. borrowing short and lending long. But SVB had a problem. Their depositors weren't traditional customers. They were startups that burned cash, that could need to withdraw millions at any moment to make payroll, to fund their next growth phase, to survive another quarter. Traditional banks spread their risk across diversified portfolios, commercial loans, mortgages, corporate bonds. SVB couldn't do that. Startups don't buy houses. They don't have the kind of steady cash flows that qualify them for traditional loans. So SVB made a different bet, a catastrophic bet. They took more than half of their deposits, over $120 billion, and invested in long-term securities, bonds, safe government-backed securities that paid steady but modest returns. In a world of low interest rates, this made sense. These bonds would mature over 10, 15, even 20 years, paying reliable income that could fund the bank's operations. There was just one problem, one tiny, catastrophic, world-ending problem that somehow every brilliant mind at Silicon Valley Bank failed to properly account for. Interest rates don't stay low forever. In March 2022, the Federal Reserve began raising interest rates aggressively, the fastest rate increases in 40 years. They had to. Inflation was spiraling out of control, the ghost of the 1970s haunting modern America. Rates that had been near zero for years suddenly jumped to 4%, then 5%. For most people, this meant more expensive mortgages and credit cards. For Silicon Valley Bank, it meant something far more sinister. Here's how the death trap works. Imagine you bought a bond that pays 2% annual interest. You're happy, but then interest rates jump to 5%, and suddenly new bonds are paying 5%. Your old 2% bond, it's worth less now, much less. If you needed to sell it immediately, you'd have to sell at a massive discount. No one wants to buy your 2% bond when they can get a new 5% bond instead. By the end of 2022, Silicon Valley Bank was sitting on a paper loss of $15 billion. $15 billion. Their securities portfolio had cratered in value. But here's the accounting trick, the regulatory loophole that let them hide the bleeding. These were held-to-maturity securities. As long as SVB held them until they matured, they could pretend the losses didn't exist. They could carry them on their books at full value, as if nothing was wrong. It was financial theater, a comfortable lie everyone agreed to tell. But it only worked if one condition held. SVB couldn't need that money. Meanwhile, the tech industry was dying. Not literally, but close enough. The free money party of 2020 and 2021 was over. Venture capital funding dried up. Startups that had raised money at insane valuations suddenly couldn't raise their next round. Mass layoffs swept through Silicon Valley. Meta, Amazon, Google, Microsoft, everyone was cutting. And all those startups banking with SVB, they were burning through their deposits, withdrawing money to survive, to make payroll, to extend their runway just a few more months. The deposits that had flooded in during the boom years were now flooding out. By March 2023, Silicon Valley Bank's management team faced an impossible choice. They were bleeding deposits. Their securities portfolio was underwater. Their available cash was running thin. So they made a decision that would trigger the collapse. On March 8, 2023, SVB announced they were selling $21 billion in securities. Immediately, taking a nearly $2 billion loss. But that wasn't the worst part. The real shock, the announcement that sent tremors through Silicon Valley. They needed to raise $2.25 billion in fresh capital, urgently. Read that again. The bank that funded the future, that backed innovation, that every startup trusted with their money, was essentially admitting, we're running out of cash. We made catastrophic investment decisions. We need help. It was supposed to be a controlled announcement, a measured capital raise, a sign of responsible management addressing a challenging situation. Instead, it was blood in the water. Within hours, panic spread through the venture capital ecosystem like wildfire. Group chats exploded. Slack channels lit up. Phone calls multiplied. The venture capitalists who had built their empires on calculated risk suddenly calculated a very different risk. What if Silicon Valley Bank fails? What happens to our portfolio companies? What happens to their money? And in the world of banking, confidence is everything. Once you start questioning whether a bank is safe, it becomes unsafe. It's a self-fulfilling prophecy written in fear and mathematics. Peter Thiel's Founders Fund was reportedly among the first to act. They advised their portfolio companies to withdraw their money from SVB. Other VC firms followed. Not everyone, not all at once, but enough. By Thursday morning, March 9th, the bank run had begun. Not the old-fashioned kind, with lines around the block and desperate customers demanding their cash. This was a modern bank run. Digital, silent, deadly. Startup founders sitting in their apartments, clicking buttons on their laptops, initiating wire transfers. $42 billion in withdrawal requests. In one day, $42 billion trying to escape through the digital exits simultaneously. SVB's stock price collapsed 70%. Trading was halted. The California Department of Financial Protection and Innovation watched in horror. By Friday morning, March 10th, they had no choice. Silicon Valley Bank was insolvent, closed, seized by regulators. The 16th largest bank in America had collapsed in 48 hours. Friday afternoon, Silicon Valley descended into chaos. Thousands of startups discovered their bank accounts were frozen, inaccessible, locked behind regulatory seizure. Companies that had millions in deposits couldn't access a single dollar. Payroll was due. Rent was due. Bills needed to be paid. But the money might as well have been on Mars. Founders who had spent years building their companies faced an impossible reality. They might have to shut down, not because their businesses failed, not because they ran out of customers or couldn't build great products, but because their bank collapsed. The FDIC, the Federal Deposit Insurance Corporation, only insured deposits up to $250,000. Most of these startups had millions. The rest, potentially gone, lost in the wreckage of SVB's catastrophic risk management. That weekend, the tech industry's most powerful players mobilized, not to help, to survive. Y Combinator, the legendary startup accelerator, sent an email to its portfolio companies. If the government doesn't act, this could be an extinction-level event for startups. They urged everyone to contact their representatives in Congress, to demand action. All-in podcast hosts, themselves venture capitalists and successful entrepreneurs, used their platform to sound the alarm. This wasn't just about one bank, they argued. This was about the entire innovation economy. But here's where the story gets darker, more complicated, because Silicon Valley's response revealed something uncomfortable about power and privilege in America. When SVB collapsed, the tech industry mobilized a coordinated lobbying effort in less than 48 hours. They had direct access to Treasury officials, to members of Congress, to the regulators who would decide their fate. And they used it, not subtly, not quietly. They demanded a bailout. Don't call it that, of course. They called it protecting depositors, preventing contagion, saving the innovation economy. But the mathematics were clear. They wanted the government to make them whole. Sunday night, the banking crisis that began in Silicon Valley metastasized. Signature Bank, a New York institution with heavy exposure to cryptocurrency companies, announced its closure. Another $100 billion in assets, gone. Regulators were now facing the second and third largest bank failures in American history happening simultaneously. Behind closed doors, Treasury Secretary Janet Yellen, Fed Chair Jerome Powell, and FDIC officials grappled with a nightmare scenario. If they let SVB depositors lose their money, it would send a message: regional banks aren't safe. Customers at every similar institution would panic. They'd withdraw their money. More banks would fail. The 2008 financial crisis had taught them about cascading failures, about how quickly confidence evaporates, about how contagion spreads from institution to institution like a virus. But if they protected SVB depositors, especially those with balances far above the FDIC insurance limits, they'd be accused of a bailout, of protecting wealthy tech companies and venture capitalists while regular Americans suffered, of creating moral hazard, of teaching the industry that reckless risk-taking would always be rescued by taxpayers. They chose protection. On Sunday evening, federal regulators announced an extraordinary intervention. All depositors at Silicon Valley Bank and Signature Bank would be made whole. Every dollar. Even accounts with tens of millions. Even the deposits that far exceeded FDIC insurance limits. The government wasn't bailing out the bank's shareholders or bondholders. Those investors would be wiped out. But the depositors, the startups, the tech companies, the innovation economy, would be protected. The official justification was systemic risk. SVB's failure posed a threat to the entire financial system. But critics asked uncomfortable questions. When community banks fail in rural America, are their depositors protected beyond insurance limits? When regular people lose their savings, do federal regulators work through the weekend to make them whole? Or does systemic risk have a different definition when it's Silicon Valley's money on the line? But the federal intervention only told part of the story. As investigators dug deeper into SVB's collapse, darker details emerged. Details that transformed this from a story about banking failure into something more sinister. Greg Becker, SVB's CEO, had sold $3.6 million of company stock less than 2 weeks before the collapse. February 27, 2023. A pre-scheduled sale, his lawyers would claim. Part of a routine trading plan. Nothing to see here. But the timing raised questions that still echo through Silicon Valley. What did he know? When did he know it? Other executives had similar transactions. Millions of dollars in stock sales in the months before the collapse. All legal, all disclosed, all perfectly timed. Then there was SVB's lobbying efforts. In 2018, Congress passed a law weakening regulatory oversight for regional banks. Banks with less than $250 billion in assets were exempted from the strictest rules. The stress tests, the capital requirements, the risk management standards imposed after 2008. SVB had lobbied for that exemption. Hard. Greg Becker personally testified before Congress, arguing that these regulations were too burdensome for institutions like SVB. They weren't systemically important, he claimed. They didn't pose risks to the broader economy. They just needed flexibility to serve their unique client base. Congress listened. The regulations were rolled back. SVB was freed from the strictest oversight. And what did they do with that freedom? They concentrated risk. They invested heavily in long-term securities without proper hedging. They failed to manage interest rate risk. They built a house of cards and called it innovation. But perhaps the most disturbing revelation came from SVB's own internal structure. The bank didn't have a chief risk officer for 9 months in 2022. 9 months. The position that's supposed to identify and mitigate exactly these kinds of catastrophic risks was vacant. During the period when interest rates were rising fastest, when their securities portfolio was cratering in value, when the warning signs were flashing red, there was no one in charge of risk management. When they finally hired someone in January 2023, it was too late. The damage was done. In the weeks after SVB's collapse, the banking crisis spread globally. Credit Suisse, a Swiss banking giant with 170 years of history, required a government-orchestrated rescue and merger. First Republic Bank, another regional institution serving wealthy clients, experienced its own run and was eventually seized and sold to J.P. Morgan Chase. The contagion that regulators feared became reality. But Silicon Valley survived. Because of course it did. The startups got their money back. Payroll went out. The innovation economy continued. And in boardrooms and conference rooms across the tech world, the lesson was learned. Not the lesson regulators hoped. Not the lesson about risk management or concentration or the dangers of groupthink. No, the real lesson was simpler. We're too important to fail. Think about the mathematics of power that this crisis revealed. When SVB collapsed, it held roughly half of all venture-backed startup deposits. This concentration wasn't accidental. It was engineered. Venture capital firms required their portfolio companies to bank with SVB. It created relationships. It streamlined processes. It made everyone's lives easier. But it also created a single point of failure. A financial Death Star that, if destroyed, would take the entire innovation ecosystem with it. And when that Death Star did explode, who paid the price? SVB's executives walked away. They lost their jobs, yes. Their stock became worthless. But they weren't criminally prosecuted. They kept their previous stock sale profits. They moved on to new opportunities. The shareholders were wiped out, but they signed up for that risk. The bondholders lost money, but they're sophisticated investors who should have done their due diligence. The depositors were made whole by government intervention. So who actually suffered? The answer is everyone and no one. The banking system absorbed the shock through emergency lending facilities. The FDIC's Deposit Insurance Fund took the initial hit, but eventually recovered most of the money through asset sales. Taxpayers didn't directly fund a bailout, but they absorbed the broader economic uncertainty. And the moral hazard, the dangerous precedent that large interconnected institutions will always be rescued, grew stronger. But zoom in from the macroeconomics, and you find real people whose lives were upended. SVB's employees, the tellers, the loan officers, the IT staff, lost their jobs overnight. Many had their retirement savings invested in company stock that became worthless. Startup founders who had spent years building their companies endured days of existential terror, not knowing if their life's work would survive. Some didn't. Some companies folded anyway, unable to recover from the chaos and uncertainty. And what about the innovation that was supposed to justify all of this? The world-changing technologies that required special treatment, special banks, special rules. Many of the startups that banked with SVB were working on genuinely important problems. Clean energy, medical breakthroughs, educational tools. But many others were solving problems that didn't exist. Building apps no one needed. Creating services that existed solely to extract value from venture capital funding rounds. The innovation economy had become so detached from reality that it required its own specialized bank. A bank that ultimately couldn't survive contact with economic reality. Federal investigations revealed a pattern of dysfunction that went far beyond interest rate risk. SVB's board of directors included multiple members with backgrounds in venture capital and technology, but limited banking expertise. Internal risk models had flagged the interest rate exposure, but management dismissed the warnings. The bank's rapid growth during the pandemic had outpaced its risk management capabilities. Regulators from the Federal Reserve and California's banking department had identified concerns, but failed to force corrective action before it was too late. The Fed's own post-mortem report was damning. It acknowledged that supervisors had identified SVB's problems, but didn't escalate them aggressively enough. That the 2018 regulatory rollbacks had reduced oversight at exactly the wrong time, that SVB's management had engaged in poor risk management, while supervisors engaged in insufficient supervision. It was a masterclass in bureaucratic failure. Everyone saw the problem. Everyone documented the problem. No one stopped the problem. But here's the truly disturbing part. After all the investigations, all the congressional hearings, all the promises of reform, what changed? Congress held hearings where former SVB executives were grilled about their failures. Greg Becker took the Fifth Amendment, refusing to testify. Regulators promised stronger oversight. Politicians from both parties demanded accountability. And then, nothing. No major new regulations passed. No criminal charges filed. The system that allowed SVB to fail continued largely unchanged. Silicon Valley Bank's collapse teaches us something profound about modern capitalism, something uncomfortable. In the world of high finance and innovation, risk has been socialized while rewards remain privatized. When bets pay off, the profits flow to executives, shareholders, and venture capitalists. When bets fail catastrophically, the government steps in to prevent systemic collapse. It's capitalism on the way up, socialism on the way down. The tech industry loves to talk about disruption, about moving fast and breaking things, about challenging the status quo and reinventing everything. But when their specialized bank, their carefully cultivated ecosystem, actually broke, they didn't accept disruption. They demanded protection. They mobilized their considerable political and economic power to ensure the government would backstop their losses. And it worked. Compare this to 2008. When the housing crisis hit, millions of Americans lost their homes. Regular families destroyed by predatory lending and financial engineering. They didn't understand. The government eventually intervened, but not before countless lives were ruined. In 2023, when Silicon Valley's money was at risk, the government acted in a weekend. The contrast is stark. The lesson is clear. In America, some people are more systemically important than others. SVB's collapse also revealed the fragility of concentration in the modern economy. When one bank serves half of an entire industry, that's not efficiency. That's a vulnerability, a weakness disguised as a strength. The same pattern appears everywhere in tech. A few cloud providers host most of the internet. A few social media platforms control public discourse. A few semiconductor companies manufacture the chips that power everything. We've built a global economy on single points of failure, and then we act surprised when those points fail. The venture capital industry, which had essentially created SVB's concentration problem, learned the wrong lesson. Instead of diversifying, instead of recognizing the systemic risk they'd created, many firms simply moved their money to larger banks, to JP Morgan, to Bank of America, to institutions that are explicitly too big to fail. They didn't reduce concentration. They just concentrated in different places, places with more explicit government backing. And what about the innovation that was supposedly at risk? The technologies that justified the extraordinary intervention? Did they materialize? Or was this always about protecting capital, not innovation? The uncomfortable truth is that most venture-backed startups fail. That's the model. Fund 100 companies, hope 10 succeed, pray one becomes a unicorn. The system is designed around failure. But when the bank funding that system failed, suddenly failure wasn't acceptable. March 8, 2023. A Wednesday morning in Silicon Valley. The beginning of the end for an institution that styled itself as different, as innovative, as specially suited to fund the future. Within 48 hours, Silicon Valley Bank would cease to exist. Within 72 hours, the second largest banking collapse in American history would trigger a global financial shockwave. But the real earthquake wasn't in the banking system. It was in the revelation of how power really works, how an industry that preaches disruption, demands stability, when its own money is at stake. How institutions that are supposed to manage risk instead concentrate it. How the rules that govern everyone else somehow don't apply to those who write the code, fund the future, and bank with the right people. Greg Becker hasn't been charged with any crime. The venture capitalist who started the bank run faced no consequences for potentially triggering a systemic crisis. The regulatory framework that failed to prevent the collapse remains largely unchanged. And somewhere in Silicon Valley, right now, another institution is concentrating risk in ways we won't understand until it's too late. Because that's the thing about dark business stories. They never really end. They just transform into the next crisis, the next scandal, the next moment when we discover that the systems we built to protect us are actually designed to protect those who need protection least. The Silicon Valley Bank collapse wasn't a natural disaster. It wasn't an act of God or an unforeseeable black swan event. It was a choice. A series of choices made by executives who prioritized growth over safety, by regulators who prioritized industry concerns over systemic stability, by an ecosystem that convinced itself it was special enough to deserve its own rules. And when those choices led to catastrophe, the bill came due, not to those who made the choices, never to them, but to the broader system, to the integrity of banking regulation, to the public's trust in financial institutions, to the idea that in America, everyone plays by the same rules. The tech world's financial earthquake shook the foundations of global banking. But when the dust settled, the same power structures remained. The same people made the same calculations. And in the shadows of innovation hubs and venture capital offices, the next Silicon Valley Bank is already being built. Because some lessons are never learned. Some patterns never break. And in the dark side of business, the house always wins, even when the house collapses. Subscribe and listen to our next story below.